Welcome back to Primary Source China Investment. This week we're on show G4, and we wanted to talk a little bit about what is the smart money, so-called smart money, doing in China. Because if you listen to full-time guru and part-time hedge fund manager Ray Dalio, listen to Oaktree CEO Howard Marks, even to BlackRock's Larry Fink, they are not changing their investment views about China. And it seems nothing is going to change their views. Not COVID lockdowns, not the ensuing protests, not Xinjiang reports of genocide, slave labor, fraud with Chinese stocks, a crackdown against democracy in Hong Kong, even a 25% decrease over the last 5 years in the CSI 300, persistent intellectual property theft by Chinese companies, sustained campaign of some American politicians to paint China as the source of COVID, and an inevitable future military foe. So there's a lot of these headwinds that are coming out, and yet this so-called smart money continues to press into China. And these managers aren't alone. The biggest pension funds, index providers, and ETF issuers are pushing Chinese stocks into portfolios. So with all that being said, peng.guo, and we're going to get into some of the numbers here. With all that being said, where do you think we stand?
In China, people back to the work after the COVID policy get lifted. It's really messed up, like the daily work due to the COVID in the past 3 years. I think all the process and the chain and whatever supply chain, they also get interrupted, and many sectors get affected. Plus the political conflicts, as well as the global interest significantly change. That's a lot of a huge change in the market. I think right now, China just removed the COVID zero policy, and then everything just started back to normal.
Yeah.
So we will see many sectors, companies, so they will get a huge change, I think, after the COVID zero policy get removed.
Yeah, there's no switch though. I mean, even you look at US, I was looking at occupancy rates and for commercial properties and things like that. I mean, back to work in New York, for example, is still only 50% of 2019. So there's some fundamental changes that even if China's flipping the switch away from COVID zero, it doesn't mean we go back to 2019.
Absolutely. Yeah.
But I did want to right size this for our viewers, because although, people are hearing about large hedge funds and big asset managers continuing to push China, how big is that for foreigners? And we need to look at the real data. So China's stock market, Shenzhen, Shanghai, Hong Kong, even Beijing, these are not global markets. Foreign ownership is tiny. So how small is it? Well, there are macro and micro gates for investing. So for example, no foreign entity can own more than 5% of any listed security on the mainland. On the macro side, foreigners must still use approved paths to own A shares, such as Stock Connect and QP and RQP. Total allocation and daily limits mean that only a few $100 billion equivalent can be invested at any one time. For context, the stock markets of Shanghai and Shenzhen only have 4,800 companies and a market cap of more than 13 trillion US dollar. So we're talking in the single-digit percent. Lower than 3% of the total market cap. That's just of the equity market. There's also a fixed income market, which is larger than the equity market. So foreign participation in the China security market, listed security market, is very small.
That's a couple of reasons. I think, firstly, as a foreign investors, they prefer like the low volatilities. So fixed income is most of the time is their choice, because China active market, they cannot afford the high volatility in this market. And secondly, like officially, like the foreign fund manager or some big name, big companies, if you see them, they probably get manage very small percentage of the asset size in China. However, a lot of the, as I know, a lot of the like the foreign monies, they can get through into the China properly managed by China fund manager, for example, like the private fund. And that recently, I know that's some of the folks. So they get receive the new monies from the foreign investors.
Yeah.
And also, you see like the tens of billions of the renminbi level private fund manager. Many monies came from the foreign investors. So that really is mixed. China as well as the international fund manager that manage the assets. It's hard to distinguish what's the percentage or what's the exact rule, because I think that is quite complicated. And right now, and China is also take the actions. They try to go deep to see the final owners of the each fund or piece of the financial asset.
This is a great point, peng.guo. So what you're describing is really this split, which is getting muddled in the conversation. One is running an investment business on the ground, targeting mainland investors, and the other is simply allocating to listed Chinese assets or even private assets.
That's true, yeah.
Yeah. So, what Ray Dalio is doing is different than what BlackRock is doing. So, arguably the greatest hedge fund manager of all time, with the largest hedge fund on the planet, can only raise 1.25 billion US dollar equivalent on the mainland in China. That is Ray Dalio's fund in China. Remember, we've covered this before, right? He's competing with just the private guys, 25,000 individual fund managers managing 140,000 different funds, almost $3 trillion equivalent. He's got a lot of competition. So that's one business, which is raising money in China and then investing in Chinese related assets. The second is what BlackRock does. They issue ETFs, they issue products that invest in A shares or H shares in Hong Kong. So these are two very different businesses, and we've talked about them in the past, but these are the two very different businesses that these managers are going after.
That's right. So and also this and the third thing would be like the Fidelity International. So they just get a license to issue the public fund in China. I know this is takes a much longer time than they expected, but they finally probably the first round they get a license to issue the fund, which is means in China market as a highly competition. And in reality, I see many big hedge fund they just sell their product in China. So they have an agent to sell it, and probably the people use the money overseas to buy those hedge fund product, and most of them they lose the money. I do see that big name. They send a very complicated structure, and even I don't understand the component, but I do understand the benchmark. As soon as I put all the benchmark together, it's a really high beta in emerging market, high risk.
You brought up Fidelity, and I wanted to remind our viewers that legendary investment manager Anthony Bolton at Fidelity moved to Hong Kong to manage a China fund and quickly found himself forced into retirement. So China investing can be a humbling experience even for some of the greatest investors. And remember, Dalio has only raised 1.25 billion. He is considered the best private fund manager of all time. He has the largest hedge fund on the planet. So if he can only raise 1.25 billion, what can mere mortals expect to raise? It's a very difficult business. So with that, I want to end show G4. Just understand that these are two different businesses and these require two different sets of talent.